Hi, everybody. I'm John Resessian, Head of Advisor Education at PIMCO, and I'm joined by my colleague, David Hammer. Dave is the Head of Municipal Bond Portfolio Management at PIMCO. Dave, welcome to our conversation.
Hey, John, thanks for having me.
Yeah, it's my pleasure. So, Dave, let's start the conversation by talking about equity market volatility that we've seen recently, and of course, the topic on everybody's mind, the prospect of higher interest rates. Can you help our audience understand what that means to the municipal bond market, both individually and from a portfolio management perspective?
Yeah, sure, John. As we enter 2022, investors are contemplating a Fed hiking cycle, about four hikes priced into the market today. A withdrawal of accommodative central banking policy, although it'll still be accommodative, less so. And that really increases the probability of volatility. And certainly, as you mentioned, John, we've already experienced this year in the first few weeks of 2022. So, I think it's important to know for tax-exempt munis, it's these types of environments that they tend to thrive from an asset allocation perspective. And first and foremost, it's performance in a rising rate environment. Looking back to previous Fed hiking cycles, munis have both outperformed taxable fixed income as rates have risen, but also delivered relatively decent cumulative returns over those time periods. So going back to 2004 to 2006 or 2015 to 18 more recently, investment grade munis, absolute returns over those time periods, about 7 to 9%. High yield munis have done a bit better, 18 to 22%. And of course, that's all without adjusting for taxes. So those taxable equivalent returns are even a bit better. And in terms of diversification, with equity markets near all-time highs and in corporate credit spreads relatively tight, it's important to note that historically munis have had lower correlations to these riskier parts of the market like equities and high yield corporate credit. And that applies both to IG munis if you're comparing them to the Barclays Agg, or high yield municipal bonds if you're comparing them to the S&P 500 or high yield corporate credit spreads.
That's great, Dave. Thanks for the comments on that. Let's talk about another aspect of the municipal bond opportunity today. I was reading an article recently where you were quoted, and you referred to the idea that state and local coffers are more flush with cash than they have been in recent history. What exactly does that mean in terms of credit quality for the municipal space?
Yeah, this moment in time is peak credit quality for the muni market, and there are a number of factors that have influenced it. Number one is that despite the severe economic contraction in 2020, state and local tax collections were only down about 1% to 2%. High income earners kept their jobs. There were record levels of monetary and fiscal policy support. Once we add in 2021 COVID relief, it actually swung state and local government balance sheets from deficits to surpluses. And throughout 2021, state and local governments were experiencing record revenue collections. The state of New Jersey announced in 2021 that they hit all-time new highs in revenue collections. And then at the local level, many muni bonds are backed by property taxes and house price appreciation. It accelerated during this crisis, very different than the financial crisis of a decade ago in which house prices were a drag on local economies. In this case, they're actually supporting local economies. And investors and rating agencies alike are taking notice here. I know in Illinois, where you're from, the first bond upgrade for the state in 25 years. So this is a phenomenon that we expect will turn into a multi-year favorable credit environment. Much of the COVID relief, it hasn't been spent yet. State and local governments have until 2024 to allocate it, until 2026 to spend it. They're also improving credit quality by paying down pensions. And as we head towards mid or perhaps late cycle at some point, this improves the overall credit quality of an already safe asset class that has historically low default rates versus IG corporate bonds or high yield corporate bonds.
An upgrade to the state of Illinois. Who would have thunk? Dave, let's talk a little bit about tax reform. If we were having this conversation in 2021, tax reform was the topic du jour. Everybody was convinced that ordinary rates were going up, that capital gain rates were going up, that there was going to be some sort of meaningful tax legislation. Of course, that hasn't come to pass. And therefore, the number of opportunities for individual investors to save on their taxes is still very limited. We've got medical expenses, if they exceed 7.5% of AGI. Mortgage interest, of course, is still deductible. Charitable giving is still deductible. And then, of course, the all important state and local taxes, which are currently capped at $10,000. Dave, let's talk a little bit about how munis fit into that context of a limited state and local tax deduction.
Yeah. I mean, you hit the nail on the head, John. There are limited places to go for tax efficient investing today. The other thing that's become limited is the supply of tax exempt bonds. The most recent bills around infrastructure, they failed to bring back tax exempt advance refundings, which allows muni issuers to refinance a tax exempt bond with a new tax exempt bond. As a result, muni issuers are actually turning to the taxable market. That's taking tax exempt supply away and converting it to taxable form. So there's simply not enough supply of muni bonds to satisfy this demand in many cases. One place that we see opportunity in value for tax-aware investors, it's the Commonwealth of Puerto Rico. The island has been going through a multi-year restructuring process. We expect the Commonwealth will fully emerge from bankruptcy in 2022. And we see value here for a few reasons. Number one is that debt has become more sustainable. The Commonwealth has reduced their debt burden by about 60% by imposing haircuts on legacy bondholders. The new bonds also offer better security protections for bondholders than they did pre-bankruptcy. So it's a higher quality asset coming out of the restructuring. And then last but not least is the high levels of tax-free yield. These bonds are not rated. They're trading with a wider spread or a higher tax-free yield. That means 4 to 5% tax-free yields as these bonds transition back into the muni market. That's equal to somewhere in the 7 to 8% taxable equivalent range. And for those investors in California, New York, it actually gets close to double-digit returns. So it's an area we see a lot of value this year, and we've increased our allocations here at PIMCO across our municipal vehicles.
And clearly, with that state and local tax deduction capped at $10,000, paper like Puerto Rico becomes really attractive for those residents of those states. Dave, thanks so much for your comments today. Very helpful. I want to thank our audience for joining us, and I want to encourage all of you to learn more about our capabilities in the municipal bond space by visiting us at PIMCO.com or by contacting your local PIMCO account manager.